are, doing our Spatium Capital quarter update. Why don't we give the audience a bit of a refresh on the investment strategy? What are we looking for? How are we looking to position the portfolio and market?
Sure. I guess the biggest things that make us different is that first and foremost, the high turnover approach. We're not the same as many other fundies out there that look to buy and hold a portfolio for a long-term holding duration. We buy our companies, we're only looking to make a small edge. Every other fund out there seems to be wanting to make huge returns.
Yeah, we want to buy and hold approach, right?
Correct. We want to make small returns and lots of them. I'd have to get the exact figures up now, but the answer is somewhere between 4,300 and 4,400 of different positions we've held over 23 quarters.
When a few trades.
when I didn't have grey hairs. Yeah. So there's a bit going on, and it's been fun. It's been a hell of a journey to get to here. It seems to be working. We're in a greenfield space. There's no one else doing what we do, how we do it. Originally, the first year or two, people said, the high turnover thing, I don't quite understand it. A bit different. And then year 2 and year 3, people said, look, I'm starting to understand it. And now we're in year 4, 5, and now we're into our 6th and shortly getting into our 7th. People say, no, I understand what you're doing. And I'm like, well, you didn't for a little while, but that's okay. So we've got that over the line. And I get it. I get it from their position as well.
Familiarity breeds confidence.
Absolutely. Right. And this opportunity is a structural advantage. We're buying companies that are temporarily out of favour from their peers. They have some sort of price dislocation to what we expect from their peer set, being their GICS classification, the small ordinaries, and naturally the ASX 300 being the broader market. There's some differences there between the industry weightings of the small ords and the 300. When these companies are expected to track in this direction and they don't, you say, why is that the case? And I guess the top line question we're always looking for is this a temporarily dislocated price dislocation? Or is this something that's been a bit more of a longer term problem with the company? So a company that's separated from its peer set, the market, and obviously the smalls for the last 12 months, we would be more inclined to say, there's something wrong with the company.
Something more endemic.
They've got an issue that's a bit more longer term, balance sheet management, product, market share acquisition, something that's not a short-term issue and is not likely to be driven by market psychology, people panicking. And then the counter example of that is to say, well, if we've had this expectation and it's dislocated for the last 3 days, 5 business days, that's interesting. Let's investigate that. That's something that possibly could be caused by panic and overreaction. But where we find it interesting is that some of those companies go on to be the 12-month problems. They're not the ones that go on to have that rebound.
Sure.
More often than not, and we're looking at that sort of 70% band of companies we've invested in have gone on to make an absolute return, and that's very useful. But there are obviously naturally some we buy into that go on to become the 12-month. It is the start of that chapter. But realistically, the alpha opportunity is in that first sort of 21 days, really.
About 80%, isn't it?
Yeah, about 80%. And then there's about 20% day 21 to day 45. And all of our, post-trade investigations have realised that post-day 45, there's not much alpha to be obtained. No. It's back into that medium and long-term holding that everyone else is doing, and it's sort of all been squeezed out. There's no juice left in the lemon.
Well, I think I might just add to the back of that as well, that for the 70% that we get right, or the 30 that we don't, there's a reason why we've always equally weighted the book. And I think that's always something that people have had to adjust to understand, that you can buy a portfolio of equally weighted positions and still outperform.
Yep.
If you're buying the discounted opportunities, right? The ones that have the alpha upside. So that's how we can obviously minimise the bad ones when they do occur, and they will occur in future. That's
Absolutely.
Part and parcel of being in market.
This is a frustrating question that people often sit down with us and say, so which one's your favourite?
What's your favourite?
We don't have a favourite. They're all equally weighted. Yeah, but come on, you've got to have one that you like more.
What's your best stock idea right now?
Yeah. It's like, we got 7 and we don't love any more of them than the other this week.
What's your favourite sector?
Yeah. What's your favourite one you're holding at the moment? We don't care, because in 45 days on average, we would have got rid of all of them.
That's it.
We're not passionately tied to or emotionally tied. And again, that's another bias that blinds people.
Of course.
They fall in love with the company. They fall in love with the thesis. They think that the opportunity, and there's plenty of good case studies out there of pick your poison in terms of company. Just because you understand something as an individual doesn't mean that the market as a whole agrees with you. And that's the problem. Buying good companies is easy. Learning to sell them to someone else for a profit is very, very difficult. And sell discipline is something we talk about quite a lot. Getting into companies is not the hard part. Knowing when to get out is another one, which speaks to our holding period. People say, would you like to let some of your good stocks have run a little bit longer? And we say, no, the alpha opportunity is over here. Constantly getting into new ones. Yes, we could have held on to 1 or 2 or 3 positions and made an extra 5 or 10%. It's outweighed by all the other ones that we could have held on and they've gone on to do nothing, and a couple that have gone on to have a loss. So you blend that together as a portfolio, your outsized performance over here is actually smaller than it would be to rebalance into the new panic, the new problem, the new issue of the day.
Sure.
That allows us to, capture slightly more offer. And what are we at the moment? 46% ahead of the bench.
Now, we're obviously in April of 2024, last quarter, so Q1 of 2024. How did we go from a performance perspective?
3.5% up. US and Australian volatility's been quite muted, and as you know, we really love the volatility. That's when these price dislocations separate. It's a lot easier for us to get in and widen the book. But volatility is an issue at the moment because you've got Iran sending drones into Israel, and now naturally their response. You've had Russia and Ukraine, you've had COVID, you've had inflation, you've had interest rates. Let me know when to stop. Issue on end. And yet none of these issues, if one of these issues happened in isolation in 2017, 18, 19, it would shake markets.
Absolutely.
You'd have issues, you'd have people pulling out onto cash. And
that's the dynamic we started in 2018.
Correct.
The smallest inconvenience in markets. Yeah, smallest hiccup, speed hump, whatever you want.
Well, the day Trump got COVID, the market fell 3%.
Remember that?
In under an hour.
Q4 of 2018, when there was that minor housing glitch in residential property, and the market shed like 11%. There you go. Like, ridiculous.
Yeah, it's weird. It just doesn't. It seems like there's volatility fatigue, no matter what's happening. And
well, if I may, before we lean into this, because I think this is a really good point. So if we look at market conditions, we've just talked about the headwinds, right? Some of the tailwinds, and possibly leading into actually what we think the outlook might be for the next quarter.
Does the RBA decouple itself from the big brother of the US and say we're going to move interest rates before anybody else? Is that a quality of life that people are going to sustain for long term, or are they going to say the Aussie dream's a bit dead? At the moment, it doesn't appear that the average Aussie is having a fair go, and that needs to shift. And the only way that's going to happen is if the RBA decides to do something out of sync with the US. The US is in handcuffs because of the US election. The
election, I think, is an interesting one because, as we've discussed before off camera, most cuts are made before the debates start because it just adds an unnecessarily weighted dynamic to the debate between the two competing parties. So realistically, the US has a handful of months left before they can actually feasibly make a cut in market without dislodging, influencing the whatever we're doing, spooking the actual election too much. So August technically would be their last meet where they could make a cut. I'd be shocked if we actually see something in September when they start the debating.
Yeah, and the reality is that we haven't been in sync with them for a long time.
No.
The structure of the top end of their market is very heavily tech focused. Ours is banking sector focused. There's too much discrepancy. We are not the same country. We're not doing the same thing. The US housing market with the fixed rate on resi makes it far easier to back-to-back products and sell those off effectively as bonds.
Of course.
And package them and CDS and the whole thing that caused the global financial crisis stems from that significant quirk that they have. Here, variables, the banks are a service provider. They're getting money and their market dealing conditions, and then they say, right, we're going to put a margin on top of that. Everyone knows the net interest margin is basically the only thing that drives the banks. The banking sector here is very, very different. The question we need to ask ourselves is two things. Why does the US have such a high tech focus at the top end? And why can't we seem to retain tech companies here, especially in the small cap segment? They're prime for acquisition, not at these interest rates. But, Atlassian's left. There's a bucket load others that have followed them that say, why would we stay here? What is the incentive to keep our employees and our base here? And how do we bring those intangible selling businesses back on shore? Is it tax cuts? Is it incentives? Is it something like that? Because it's not necessarily the tax that the corporate pays. It's the people they employ and the salaries they pay them that go on to pay income tax, superannuation,
luxury car tax.
You've got alcohol excises, you've got GST, you've got stamp duty if they buy a home. The list goes on. If they rent, the other person's getting his rental income, assuming that the property is positively geared. There's so many taxes in this country that it's not necessarily the biggest concern should be on corporate tax. It is a big sliver, but something that to be looked at. How do we stop that brain drain and that corporate drain from that small cap segment 101 to 300 that are never going to break into the top 50? The big four banks, and obviously their total dominance on everything that we do here in terms of financials, but we can't continue to just keep selling land or property developing, building apartments, doing all of that as a long-term achievement of the national strategy of how do we grow wealth in this country. The only way to grow wealth is to continue to push the listed equity markets, to continue to grow, incentivize companies to be here, continue getting bigger, and in turn continue to create jobs here in the process, which will lead to all of us having a better quality of life.
If I could cast you one final thought on what would be, we're in July 2024, right? We're now doing a review of Q2 of 2024. What's the one thing we're going to be talking about? And I know forecasts are dangerous, but if you had a Hail Mary out there, and I might lead with, do we think the RBA has the stones or the guts to make a cut in interest rates before the US does?
I think they're in such a bind. If they cut rates, what does that set it up for? Is there expectations of future cuts? Does that lead to the inflation genie getting back out of the bottle? Does the borrowing capacity of some of these projects that we see on mines and other corporates become too easy, and then it kicks off another sort of run in inflation, which will lead to us having to go up rate curves really, really high again, like we saw last time? Possible. Probable. If you cut too early, it'll lead to issues. Is it too early? Hard to say. The other side of the coin, do we hold as an economy and continue to politically bash the RBA, who said no rate cuts until 2024? We've had a truckload, and then now they're holding and be seen to be doing nothing. Maybe. I think they're going to receive pressure to do it. I dare say it might be earlier than necessary, given what we've seen unfold in the US and here. Jobs stayed strong, property market hasn't fallen 10, 20%. And again, great for the short term, helps stop recessions, fantastic in the short term. They're like a country. But does there become a point where the Aussie dream just becomes so out of touch or so unable or unfeasible for the average punting middle class? So I think the RBA will be seen to sit on its hands at the end of Q2. But it feels like at this point it's the right play. And we wait for the US election in Q3 and Q4.
Some fireworks coming at the end of the year.
Q3.
Good update, mate.
Hopefully.
Great summary of the quarter.